Welcome back. Well, as we've been saying, the market's still under the weather. It's 8160 now, a tad better than the 8152 where we left it, but really not showing any spirit at all. And it's plunged below this the series low. It's plunged below yesterday's low, which was 8185, 8180. So this is looking a little bit eerie. And up until first hour of trading, we still have not found any determined buying, any sense that the market is now giving value. So this looks like it's a little eerie. It's not yet panic selling, but it's very close to that. Let's shift back to fundamentals, which we are getting from the corporate earnings. The stock on our radar now is Raymond Limited, and joining us now is Mr. M. Shivkumar, the CFO of Raymond. He's joining us on the phone line. The company reported a 13% rise in its total income in the third quarter. However, EBITDA is down about 25% to 92 crores. Shivkumar, good morning. Thank you very much for joining us. Well, take us through the numbers. Revenues have not done badly at all at a time when demand is very bleak. But why is it that EBITDA is not able to pull itself up?
Yeah, morning, Lata.
Yep.
This is quarter four, not quarter three.
Quarter four, yes.
You referred to, yeah. The growth has been 13%, but the overall growth for the year has been 17%.
Okay.
See, there's been good milestones this year. I'll go through the quarter also. Revenues have crossed 5,000 crores. For the first time, it's 5,333 crores. Our stores count have crossed 1,000, now it's 1,003. Our apparel revenue has crossed 1,000 crores. Working capital has been released to the extent of 150 crores. There has been significant increase in the ad spends, both in the quarter and during the year, which is why the EBITDA numbers have been on the lower side. Significant increase in the advertising cost to the tune of about 45 crores. Having said, we have had our own problems in the engineering segment and automotive segment, which has been a setback. We have lost certain volumes both in the domestic and export market, which would at least take about another 12 to 15 months to get back those kind of volumes, partly on account of the situation prevailing in Latin America and certain part of also. And apart from that, our FMCG segment, where share of profits which used to get good ones, we had envisaged for growth, but market was little muted. So our PAT on a yearly basis has increased by 5 crores to 113 crores above last year. This is despite engineering business impacting us negatively over last year by 24 crores, FMCG by 12 crores, and ad spends during the year having gone up by 90 crores.
Okay.
So if you look at textile sector and apparel sector, the overall revenue growth has been 17% during the year, textile 24% and apparel 15%.
Okay.
Okay. Mr. Shivkumar, hi, morning. So by the end of this fiscal, you've done about an 18% growth on your top line. But given that you are seeing, slowdown in some LATAM countries, etc., do you think you can do the same kind of growth in FY16 as well, or will it be much lower than 18%?
See, those places that I refer to is more in automotive sector, primarily engineering, which is the files and tools segment that you are talking about. On the garmenting side, while we are reasonably okay with the growth, but there's some amount of demand slackness what was witnessed in US and Japan, which I believe will come back in about 2-3 months' time. Okay. Otherwise, the growth is good as of now, with growth in textile apparel segments reflecting consistent trend in the last 3-4 quarters, barring one quarter in third, which is mainly in the apparel. We are hoping for a good outcome in the coming year, subject to, of course, any macroeconomic factors impacting our business adversely.
Okay. Would you have to persist with such high marketing spends? I mean, this 1,063 crores that you spoke about?
No, the incremental spending was of the order of 90 crores.
Okay.
Group-wide, we spend, on a annual basis, advertising and the promotional spends. Generally is about 228 crores, whereas last year it was about 140 crores.
Okay.
And maybe there could be some, we had spent a lot of money in the World Cup and all, of the order of about 24-25 crores. Maybe to that extent, there could be some reduction in advertising costs, but it all depends how the market takes off and where we need penetration of our brand, and now it's a brand building exercise in any case.
Okay. Your core textile business, as you said, has picked up quite well. In fact, your margins are now at 16% in that business. Do you think you can better that in this fiscal?
This year, there's been a good takeoff both in the textile and the shirting fabrics both. And, it's too early for me to say about the next year. Quarter on quarter, we will be able to respond. But the secondary, if you look at like-to-like sales growth, generally across the network is about 7%. We have been renovating our stores, and the impact of that will be felt next year. We have added 49 stores in the TRS network, and so we expect a good amount of traction going forward. And we will also be renovating the existing stores so that it will be more apparel-centric rather than completely fabric-centric. So we will have a mix of growth both in the textile and apparel segment.
This softening of your EBITDA margins to 7% from 10% in the last reported quarter, do we see it reverting back to 10?
Yeah, which segment are you talking about?
Overall, your EBITDA margins in the fourth quarter?
EBITDA margins mainly got impacted on account of the advertising cost also.
On account of the, sorry?
Advertising and sales.
Oh, okay.
So definitely come back. Though first quarter is always not the
Okay.
It's only the second and third quarter is the peak quarter for the textile and the fabric industry.
Actually, the line is misbehaving, so let me quickly get this one also out of the way. This Gokuldas subsidiary that you bought, what is the acquisition for? What is the price you paid? What kind of gains are you expecting to squeeze out?
No, we have committed to purchase this unit where we will be making 1.26 million pieces a year, which is about, the cost is 30 crores, and we increase our capacity, and that's how we went. And this is one of the units of the Gokuldas. There are many units, but we are talking about one unit in Bangalore, which we will be acquiring. It will take another month or so before it formally comes into our bracket.
All right, Mr. Shivkumar, we leave it at that. Thank you for joining us and taking us through your numbers. So that's the word coming in from Raymond. Good set of numbers is what the company has reported. The markets continue to be lower, so the Sensex is still down more than 250 points.